LiteFinance, the world of financial freedom.
Hello, it's Monday 21st of August and it is time to start the market forecast. Today we will, as always, analyze major macro publications from the calendar and prepare fundamental analysis for Euro-USD so that we can make a trading plan for this week. So today, as usual, nothing is happening. Tuesday, we could say, is rather empty as well. On Wednesday, we have PMIs from the biggest markets and crude oil inventories. On Thursday, we have core durable goods orders from the US, and on Friday, GDP from Germany and the Tokyo agglomeration CPI. So, as you can see, this week is rather calm in terms of the calendar. And now we can move on to fundamentals. So, when everybody buys, think of selling, and vice versa. The Treasury bond sales seem to have gone too far, with the yields reaching the highest levels in more than 10 years. The higher the rates are, the more money the Treasury needs to cover its growing debt. The return of 5% rates is bad news for the US, which allows us to hope that bond yields will drop sooner or later and the Euro-USD quotes will rise. But when exactly? Whether or not the epoch of 1970s will return is a conundrum for investors. If it returns, the Fed will hardly cut rates in 2024 and the US dollar will remain strong for long. Conversely, bond yields may fall when the idea of a dovish return starts circulating in the market again. So the Euro-USD will then touch a bottom and move upwards. Jerome Powell's address at Jackson Hole can give us a clue. Bloomberg believes the Fed chair's rhetoric will be balanced. He will hint that the tightening cycle may end soon, emphasizing at the same time they need to hold borrowing costs on a plateau for a long time. That corresponds to the derivatives market's expectations that the Fed's fund rate is 89% likely to remain at 5.5 in September and 31% likely to rise before the end of 2023. Is the Fed's mission completed? One can think so, watching inflation slowing down and Treasury yields growing as a fear of a recession fades away. However, Jerome Powell can take markets by surprise. The FOMC's latest minutes show that the officials estimated the risk of an inflationary boost as high, which may require a further rise of borrowing costs. Also, because the labor market isn't cooling down and consumer spending remains up. On the other hand, the CPI slowed down significantly, just like average wages, while households' savings are dwindling. So Americans have to count on their wages as the main income source, which may drastically cool the labor market down. If that's the case, bond yields will drop and the Euro-USD will rise. For that to happen, US macro statistics must worsen, but the absence of hawkish surprises for Jerome Powell can also trigger a profit fixing in Euro-USD shorts. So when everyone is selling, there's a perfect opportunity to buy. So the Euro-USD's pullback to the upside can occur earlier amid upbeat business activity data from the Eurozone. At the same time, the bears' failure to make quotes return below a 1.086 will show their weakness and give us a reason to buy the euro-dollar on the news. And so, that would be all from my side for today. Thank you guys for watching, and as always, see you in the next video.